let's get started. So this is a part 2 webinar for getting started for getting ready for year-end close. So just a housekeeping items little quick. I know, I mean, those of you who are joining it for the very first time, just as you guys know, we are recording this webinar. As I said, this is part 2. We already recorded the part 1 in the last week itself. For any questions, feel free to kind of ask in the chat. I do have my colleague Manish on the call who will be able to assist you with any sort of questions. Um, those of you who are joining it for the first time, I just kind of quickly introduce myself. I'm Hardik, one of the founder at Xenett. By nature, I'm also an accountant with more than 15 plus years of experience, and we actually created Xenett to solve our own problems, right? So just a real quick introduction. All right, before we actually jump on what we're gonna be covering today, let me just quickly recap what exactly we covered in part 1. So we briefly talked about what's really involved with the year end close. How do we actually get started with the year end close process? In specific, we talked about what are the how to literally review bank accounts, credit card accounts, the merchant clearing accounts, undeposited funds, fixed assets, employee advance, account receivable, and accounts payable. So we talked about all of those review points, and we also talked about different checklists that we should be following while reviewing these different kinds of accounts. Now, in today's session, we're going to be primarily focusing on these topics. We're going to talk about accruals, loans, payroll payable, and like all together payroll payable, payroll taxes, equity, profit and loss review. And then at the end, I'm also going to talk about some of the best practices that we should be following. All right. So that's that. Just gonna make sure it's all open on my end. So let's just talk about accruals, guys, first. So if you talk about accruals, I mean, broadly speaking, I would segregate into the main two kinds of accruals. One is we make the accruals when like some expenses are missing. So for example, the recurring expenses like rent, utilities, which includes like electricity or some sort of recurring payments that we are making every month, and for whatever reason if we are missing that particular expense, then it's called missing entry, and we typically make the accrual for the missing transactions. That's like one kind of accrual that we make. The second accrual is more of a timing difference. Now, when I say timing difference, like as an example, I would say it's a payroll. So at times we have a payroll where like there is a like overlap of days. Similarly, there is like a merchant fees. So let me give you an example. I think some merchants, what they do is that, let's say for my entire month's settlements, what they do is that they're gonna charge me the fees in the first week of the next month. So in a way, if I'm talking about February, they're gonna charge me in February, but for the previous month, right? Now in this particular case, I have seen that like people do accrue the January expense in January, and that's what I mean by the timing difference. All right. So in case of accruals, it's very good practice to have a list of recurring transactions that you expect to see every month. So we typically prepare a like checklist in Excel where I have list of all my expenses. I just want to make sure that I'm not missing any of them, right? Another thing that we do with Xenett, those of you who are using it, we have a if I go to cleanup, there is a GL consistency review where we do have it like by GL. So that gives me some idea as to every single account. I can see the consistency over the month, right? So sometimes if I'm missing anything, it will also give us some idea, and accordingly we can decide if whether we need to accrue it or not, right? So that's like a, it's always good to have the list of the recurring expenses that you expect to see every month. Now, in case of accruals, we typically make it on the last day of the month, and then we reverse it out on the very next day. So nothing like any nothing like, it's not complicated at all. It's just that I think, as I told you, if we already know the kind of expenses that might require accrual, then that makes the whole job very, very easy, because then we don't have to go and look for what we need to accrue. Typically, I have seen the most accrual, the kind of expenses that for which we have to accrue remains same. Like most of the times, it's payroll, it's merchant fees. Sometimes I have seen people accruing interest, right? So I think as long as we know the list of expenses that typically require accruals, that makes it super easy. On that line, loans. I know we briefly talked about loans while we were talking about the bank and credit card. But again, that is also very, very simple. With the loan accounts, the very first important thing is make sure that we should be allocating the loan payments between the principal and the interest. That's number one, right? Number two is, we just like we have a bank statements and loan statement, we should also be reconciling the loan ending balance with the loan, I mean, as per statement, with the books as well. In fact, what we also do is that, just like we literally reconcile bank and credit card accounts in QuickBooks, it's also a good practice to also reconcile the loan accounts as well into the QuickBooks as well, right? So it's like we literally go to reconcile, enter the ending balance as per statement, and then once the difference is zero, that's when we hit the reconcile, right? So I would suggest that that's a best practice to do, because in a way, like, that automatically takes care of both these review points that I was just referring, loan, like principal versus interest, and then the ending balance as per statement and the books would match. All right, so that's like a very, very straightforward with the loans. Now I'm going to talk about the payroll. So with the payroll, 1 second, there is often a confusion I have seen between different terminologies that we use. One is accrued payroll, then sometimes we have payroll payable, sometimes we have payroll tax payable. I mean, sometimes it's very, very, like, I have seen people are actually confusing all these accounts all together. So I thought I'll just quickly explain why, I mean, what each of these accounts stands for. I'm going to quickly open a spreadsheet just to really explain. 1 second. Right. All right. Now, to give you guys a quick example of, because I've kind of been through this. So to simplify the payroll payable, let's imagine there's a payroll period which ends on 12/8. Let's imagine the payroll period is 12/15 to 12/18. Now the actual, let's say the net payroll payable was 45,000 and the tax payable was 1415. Now these are actually the true payable for the payroll if we talk about 12/28, because in this particular case the check date is that, I mean, I have not mentioned this, but imagine the check date is like first of or second of the next year, right? If we talk about the balance sheet as of 12/31st, my balance sheet should show 45,000 for net payroll payable and the tax payable for 1415, because these are my true payroll payable. I would not want to I would say merge the accrued payroll with this. I would like to separate out the payroll accruals from the payroll payable. I would keep these two accounts to reflect the actual payables balance. Whereas if we talk about the accrued payable, accrued payroll, that would mean that for the period 12/29 to 12/31st, like for, or I think four days. Well, all we need to do is that we have to accrue it, so that way we just kind of separating it out from the payroll payable, and because we will also be um, reversing this accrual the very next day of the month. So we would want to keep these accruals separate than the payroll payable. So this is how we recommend following the chart of account structures, where you have the actual liabilities listed separately and then the accruals listed separately, right? So that's how we manage this accrued payroll and the payables account. Now with the payroll especially, so this is what we do. I mean, imagine by the time, let's say I'm accruing this 12/29 to 12/31st, if I have the actual payroll already run in the January for that period that covers that period, I would use that period and accordingly proportionate the payroll for these days. But let's say if by the time I'm, let's say, doing my close on 6th of 6th or 7th of January, and this payroll is actually not run, but I still have to make the accruals, then I would take the base of the previous payroll period and then I would accrue it accordingly based on the number of days, right? So you guys can take that call as to how you want to accrue it. But all I wanted to explain is that why these different accounts and why we should be keeping these three liabilities separate. All right. Now, with the case of payroll payable, most times we use the third party agencies like ADP or Paychecks or Gusto. Ideally, that payroll payable, I mean, should get nullified on the immediately on the check date. So let's say if the check date was 5th of January, then as of that 5th of January, I would expect payroll payable to show zero balance, because typically that just get paid through agency. With the payroll tax payable, it all depends. I have seen that different agencies work differently, but most times it also gets like that even the taxes are remitted to the states and IRS at the same time. So even with the payroll tax payables, you should expect zero balance right there. In case of those who use Intuit payroll, I mean, they actually make some payments on quarterly basis, because I mean, different taxes are due at different time. So as long as we know that whatever the balance in payroll tax payable is actually payable, then we should be fine. I mean, it should show the balance that should be paid in the future, right? So in case of payroll tax payable, that's like only thing that we have to keep in mind. Like the balance should be getting paid in the future. And as I told you, different payroll agencies work differently. So as long as we know that how this payroll agency is making payments, we should be just fine with that, right? And I think I know Intuit, I've kind of used so many different dealt with so many different agencies. They do provide the payroll tax liability report as well. That also gives us some ideas as to like, hey, this were the different taxes due, these were the different payments made towards that, and accordingly we can clearly find out what is still unpaid, and we can quickly match that as well. Now, not so often. I have also seen garnishment and child support liability as well. This is something, if it does exist, we need to make sure that we have a proper liability accounts exist for those two liabilities as well. In fact, I've also seen where people, rather than just like, I mean, they just directly record those payments as an expense, right? Because they just probably just didn't know like where they should be coding it, right? So we have to keep in mind if there's a garnishment or child support liability, we have to make sure, because we have to deduct it from employee and then pay it to the government, right? So just want to make sure that we need to have these liabilities separate. Then so these two liabilities will have its own independent accounts, will not be merging it with payroll payables or payroll tax payables as well. All right. So let's any questions so far, guys? Let me just quickly check the chat. Just want to make sure. So feel free, guys. If at all you guys have any sort of questions, I'll be kind of stopping in between and just going over. And feel free to also comment if there is something that you guys do differently, or if you guys do something additionally or additional review points. I would also want to hear that as well. Now I'm going to talk about the equity. For equity, the number one thing I kind of have come across very often is opening balance equity. First of all, this is the default account that QuickBooks creates, but ideally there should not be any account like this. Uh, it's just a temporary, I would say. Like QuickBooks has a way where if you are entering direct balances through chart of accounts, it would just adjust the balances to this account. But each entity type has its own structure, and I'm going to pull that up as well on my screen. So it all depends on what kind of entity structure that we have, and accordingly we need to have the proper equity account. So I do have examples of what like I mean, what should be the structure of equity accounts depending on what kind of entity type it is. So in case of corporation, S corporation, partnership, and Schedule C, these are the different accounts. Like these are the different accounts. I mean, the equity structure that we should have it. As I kind of put it into red, this account should not exist in any kind of this kind of entity types, right? So we just want to make sure the account can still exist, but it should not have any sort of balance. So these are the structure. This is the structure that we should be following. Now, I do have some more information. Out of all these entities, the only one that is tax paying is the corporation. So corporation is the only entity type that will be making the tax payments. And in that particular case, we will have an account called income tax on profit and loss, which is also created as other expense, right? In any other entities like S corp or partnership, there is no income tax that need to be paid by the company itself. It's called pass through, which means whatever the income or losses that are reported by these entities will be reported to their shareholders or partners or owners individual tax returns, right? So we just want to make sure that if there are any income taxes as such ever paid, it's not the company's taxes. It could be probably your partner or owner's taxes. Then we have to kind of put it accordingly. We just want to make sure this information, officers compensation and insurance, especially in case of corporation, should be recorded separately, because there is a need for like when we are filing the taxes, there is a need to report those taxes to the in the taxes in the tax return. So we just want to make sure if those information, like if we have separate accounts for this, we can easily find those information handy and we can report it accordingly. In case of partners, um, it that's gonna be guaranteed payments, and again it's very important that we don't club these guaranteed payments with the normal salary or wages. It needs to be shown separately, right? So again, it's the same thing, we have to report it separately on the tax return, so that's why it's important to have it recorded separately. Now this is like mainly about the chart of account structure, and it's more like a one-time thing. You don't have to keep an eye like every month or every year, but yes, like while you're anyway looking at year-end close, just make sure that these things are taken care, right? But especially with the chart of account structure, I mean that generally remains same, except in case of partnership. Unless you are introducing a new partner, then you might be adding new accounts, but otherwise you don't typically make any changes to the chart of accounts as such. All right, so that's more about the chart of account structure for different entities. Now with the equity, there are a few things that I personally keep an eye, which is number one, that what are the new transactions, especially with introduction of capital, common stock, or distributions, or draw, right? Uh, First of all, it's not so common to see new equity transactions every month right? But especially like it's very very important as when we are doing the year end close, we want to find out that hey, what are the new equity transactions that have been done. It's more like a just want to make sure they are recorded correctly, right? It's not like it does not reflect any sort of loan as such. It should not reflect any sort of customer payments as such. So it's very very important that we verify that all those new equity transactions are accurate, and especially with the draw, we just want to make sure that first of all it does not include any transactions that are actually for the business, right? That's why I kind of always pay attention to if something happens to equity. It's always good to quickly check and just confirm that whatever transaction that we see in draw or distributions are for the personal purposes, like are related to the owners or shareholders, and are not really related to the businesses, right? So that's like a two additional points that we check in case of equity. All right, now I'm going to talk about. At this point, we have broadly covered the different balance sheet aspects. I mean, these are the most common ones. I mean, different industries or different kinds of business will have their own different accounts. Like some account, like for example, if we are talking about restaurants, they may have some more liability accounts like tips and things like that. Some businesses might have deferred revenue accounts. So I'm not gonna talk about those specific accounts in this case. I kind of try to cover the most common ones. All right. So now I'm gonna talk about. I'm gonna take you to the profit and loss, and I'm gonna talk about what are the different things we should be checking when we are reviewing profit and loss. Now, with the profit and loss, so number one, let's just talk about the revenue. Now, here is the thing. I mean, once we understand how the revenue is being recorded, there's a pattern. Like, for example, let's say if I just talk about our own businesses, right? I mean, if I look at our revenue, I will always see the customer invoices recorded in that. Now, if I see any deposits, like we use Stripe, so if I see any Stripe deposit directly booked to the revenue, that means like the revenue is double booked, which means like I still have the revenue recorded in form of invoices, and then I also booked my Stripe deposit as invoice in as a revenue as well, right? So this is one thing we should definitely check, is that how the revenue is being recorded, and just want to make sure that there is no duplication as such, right? So that's that. If we are using any sort of point of sale system, so I have seen that some businesses like hotels or restaurants or some third party apps where we actually use it to book revenue, it's also a good practice to reconcile both the numbers. So we always do a year end reconciliation, just want to make sure whatever is reported on point of sale system or billing system is matching with the revenue as well. All right, that's one thing that we check. Obviously the consistency review with the profit and loss. Now, when we typically check year over year, uh, consistency is something I would um, highly emphasize. If we are literally checking it on like literally monthly basis, it's also a good practice. So I actually do it two ways. One is I also look profit and loss like literally every single month. I have all the 12 columns. Just want to make sure like how overall picture looks like, and then I would also check profit and loss like year over year. So that way I kind of look for consistency from on both the ways, like month over month as well as year over year as well. That's another thing. Negative amounts is something I would always pay attention to, because negative, I mean, some accounts are okay. Like for example, let's say if I have refunds or if I have discounts, like those accounts will always show negative accounts, I mean negative amounts. But then if you see like something on revenue or something on expenses as a negative numbers, it should always draw your attention and need to, I mean, negative does not really mean it's wrong, but we should always check and find out like why it's negative. All right, so that's another thing that we check. In fact, one thing, let me just show you. We have actually recently introduced this new review point. I don't know if I have it here, but I can just let me just import it. So we actually introduced a new review point. So if I just import, it says credit to expenses and debits to income, right? So what it does is that anytime if there are any transactions on my expenses which causes the negative numbers, that would tell me. And similarly, if something is debiting on revenue side, that would also highlight me. So that way I just very easy for me to find out like why it's negative, for what transactions makes it negative, right? So this is kind of easiest way to look that. All right. Entry posted to parent account. I mean, pretty straightforward. Those of you who use Xenett, we already have it as a separate review points where we can clear. I mean, again, see, this is something like entry posted to parent account is not gonna make your numbers off. Like your bottom lines will still remain same. It's more of a internal reclassification. So I would, I mean, this is something I would not like to see. So if I see and something, it just somehow irritates me personally if I see something at the parent level. So I am very much particular. So if I see anything here, I would always make sure that it should get reclassified to appropriate sub accounts. All right, so that's a thing that we should be checking. Uh, Uncategorized expenses. If I am finalizing my year end, I would not expect anything as uncategorized transactions. So if we see something like that, we need to make sure it should be reclassified to appropriate accounts. We'll also keep an eye. So one thing that I also do is that like this summary here, like GL consistency review by vendor. So this I think there is a in QuickBooks also there is a way to look not exactly this kind of report, but it actually shows all the detailed transactions. I actually use this GL consistency review primarily for two reasons. Number one is that obviously consistency. So if something is like not consistent, I can easily find it from here because now I can see month over month. Second thing is that I can quickly see how all my vendors are coded. So that way, if something is misclassified, I can easily pull up from here. Number three is that because now I have a like a vendor name and I have account name, at times if there are any sort of personal expenses recorded as business, we can easily find it out as well. I have seen a lot of times like owners are literally paying for Netflix or YouTube Premium and like salon and things like that, right? So those kind of expenses, if I'm looking at like this, and if I see YouTube or if I see Netflix, I can clearly see that hey, this could be probably a personal expense. We would then move it out from profit and loss and put it to balance it, right? So again, you don't have like there are multiple ways to check this information, but I particularly use this one because I have all the required information in front of me, right? So that's that. Yes, this is also one good thing to be checked is expenses that can be either capitalized or that can be either could be the prepaid expenses, right? And again, for this, we need to make sure that we need to have a defined threshold limit. So again, in Zenit also, we do have a default review points that easily tells us that, hey, these are possibly prepaid expenses, possible prepaid expenses, right? Because this is how we have configured here. So like I have defined that if anything in certain accounts, like for example, dues and subscription or software expenses, and if that is more than certain amounts, like let's say $5,000, then I want to see them, and then accordingly I can decide whether I want to make a prepaid expense adjustments for that or not. First of all, need to know whether it's a prepaid expense or not, and accordingly. So at least this gives those information handy for me. Exactly the same way, we also need to check if there are any such expenses in the accounts like office expenses or office supplies or repairs. Those some of the accounts where there can be potential expenses that can be capitalized. Again, same thing that you can do, you have to have a threshold limit, and anything more than that, you can decide whether you want to capitalize them or not. right? So that's another thing that we should be keeping an eye on. All right, so that's that. Yes, this is a most common thing that I have seen, which is this sales tax expense. So first of all, sales tax is not an expense, but I have still seen. So this is what I have seen happening. So like let's take an example. The deposits are coming from Amazon, or deposits are coming from Stripe, or any sort of third party merchant accounts. I have seen people directly recording those deposits to sales accounts, right? But that deposits are those deposits are inclusive of the taxes like sales tax. So what happens is that when the sales tax payments are done, they just create it like an expense here and they just book it here, right? I mean, see, the net impact will be okay, like, I mean, overall, because it's included here and then it's like subtracted here. So net income is fine, but it's not a true presentation of profit and loss. Ideally, we should extract the sales tax from sales, put it to liability, and then this expense like this these amounts from here should be adjusted towards the liability, right? So if at all you see these kind of accounts like sales tax expense, it's not the right way to present it. So we need to make sure that we just reclassify to appropriate accounts. um, at the time of year end, because typically sometimes we may not pay attention to the chart of account, so it's also a good time to pay attention to how chart of accounts are structured. I have seen at times like some of the identical accounts. So sometimes you have payroll wages, payroll expenses, and salary wages. Sometimes like you have telephone here and then some sort of related expense somewhere else, right? So it's also a good time to also look at the chart of accounts real quick and just make sure that it looks in sync, like the chart of accounts has to make sense as well, right? Again, that's not gonna throw any, it's not gonna make the bottom line wrong as such. It's a good way to make sure that the profit and loss is represented correctly. All right, so that's another thing that we generally keep an eye. Now, this is something, especially with the payroll expenses. If we are using third-party agencies like ADP or Gusto or Paychecks, we typically enter the payroll through general entry. Now, when I'm looking at those accounts, I would not expect any sort of direct checks, right? If there are any checks directly recorded to those accounts, I mean, it could be most likely wrongly recorded. It could be probably the reimbursement. It could be probably the advance, employee advance payments. It could be anything, but it's not usual, right? So I'm not saying it is 100% wrong, but it's not so common to see checks if you are actually recording payroll through journal entry. So if there are any such transactions that you see, and especially with even taxes as well, we typically record employer taxes through journal entry, right? If you also see some direct taxes payments recorded to those accounts, again, it could be wrong. Most of the times we need to make sure that those tax payments are not, are should not be like it. It should probably be an adjusted to payroll tax payable and not the payroll tax expense. So the the way I would look at it, if I kind of been recording through journal entry, I would always expect journal entry in those accounts. If I see some direct random payments, then I would want to investigate and find out like what are these payments for, right? And accordingly, we will just adjust it. All right. So that's another thing that we'll keep an eye with the payroll. All right. I'm just gonna quickly see and make sure I'm not missing out anything real quick. We do have a duplicate entries. Typically, it gets indirectly covered. Um, if you are so as a part of this process, we do have a possible duplicate entry. So as long as if the accounts payable is reviewed correctly, and if there are not unclear like I would say unusual unreconciled transactions, then this is taken care automatically. But because we already have it we this also at times impacts the profit and loss, especially this kind of situations where there's a bill and then there's an expense. So you have a originally an expense was recorded through bill, and then when the bill was paid it was actually recorded as a different expense altogether, right? So this is a classic example of duplicate transactions. So but ever like as I told you, if you are using Zenit, then this can easily be caught. But if you even if you are not using it, as long as if you have taken care of your accounts payable review, and as long as if you've taken care of at times like unclear transactions, one way or another this kind of situations will be caught, so it shouldn't be a problem as such, right? All right, yeah. And one more thing is, this is something, two things actually, it's more of a cleanup. Again, this is not gonna make as such any difference to the bottom line, but it's a good time to make sure that we clean our master list. That means like we look at the vendors, customers, GL, and everything. So there's one that says duplicate names. We generally do it on quarterly basis, but as such, it's year end. So it's good time to quickly look at all of the vendors, customers, employees, make sure if there is anything duplicates, we will just make sure we merge them. Just like that, if there are any such vendors that haven't been used for a while, if there are any such customers that haven't been used for a while, same way for chart of accounts, right? It's also a good time to identify those vendors, customers, and accounts and make them inactive. So that way we have a good start for the next year. So we do kind of start with the clean list, like good and accurate vendors, customers, and GLA. So as I told you, nothing not gonna impact as such the numbers, but yes, it's a good practice to take care of that. So that's like we also include this in our year-end checklist. All right, so that's like a profit and loss. Again, I have only tried to touch base on the most common things. Each business works differently, right? And accordingly we have to review it, right? So kind of, for example, cost of goods sold entirely is dependent on the income. So if we kind of know some gross profit percentage, inventory is involved, then obviously there are going to be some more review points, but I have not tried to get into that. I've tried to kind of touch base on very high level and very common review points that we have to pay attention to. All right. So this is a profit and loss and balance sheet review. Now I'm going to talk about some of the best practices that have helped us have a very smooth and clean year end close process for our clients. Number one thing is that for us, there isn't as such anything like a year end, because the same kind of practice that we typically follow every month, right? So imagine if we were doing all of if we were checking all of those review points every month, then there isn't anything as such we are doing specially for the year and only. Yes, there will be certain adjustments like depreciation or equity adjustments at times, but most of the things would be anyway accurate as a part of year end close. So for us, if you ask me, lately, like last few years, I have not really seen like us spending so much time or being overwhelmed with so much of like chaos for year end. I like it's been very very smooth, and especially as we use Zenit also, because we kind of do it more of a real time review. We don't even keep stuff even for the month end close process. We try to resolve things on a weekly basis. So by the time we work on month end close process, it's like most of the things are already clean. So there is number one thing that have really helped us is that we have not like allowed to are allowed ourselves to accumulate things. We have been literally doing or executing things in real time. Number second is we always used to have a checklist. This kind of check. So this is like a checklist that we used to follow in Excel before, right? So it's always good to have some sort of checklist in place rather than doing some guesswork like, okay, I check this, I check that in our mind. Because at times, if we don't have some sort of checklist or sign off process in place, it often leads to duplication of work. I've seen where um I remember those days where like junior staff would come and tell me that, hey, I check everything, it's good to go, like you can review if you like. Now imagine me. I mean, I do not have anything in front of me. I do not have any clue. I'm looking at is profit and loss and balance sheet, and these are only numbers. And I just cannot say that it's all accurate unless I go and check everything by myself. Right. So we used to then we actually introduce a kind of checklist that I would want my staff to follow, and I would want them to put some sort of status against that, and I would want them to put some sort of review notes. So if you are using any sort of applications, not just Excel, if you use Xenett, if you use whatever your task management system is, it's always good practice to have some sort of checklist. So we do have a comprehensive, very standard checklist that we always use as a base, and then depending on the nature of client, we then customize it. So we then remove unwanted ones, we then add the specific ones, and that's a kind of checklist that we always follow. So the same kind of checklist I have it in Excel. Now we actually have it created in Xenett in form of closed checklist, right? So now my staff would actually follow this. They kind of say that, hey, I check this, and then they would also do the sign off. So that gives us a peace of mind that all of those things have been thoroughly checked, right? So that's another thing that have really helped us having the accurate numbers for the year end. Number three is the working papers. So I'm going to show you the format that we used to follow. In fact, we follow even as of today, but we used to kind of create the whole Excel working papers where we have a trial balance exported, we have a balance sheet, profit and loss, and most importantly, for every single balance sheet accounts, we have a rule that we need to have some sort of justification, some sort of evidence or statements or documents or working files that justifies whether the balance that we are showing on balance sheet is actually correct or not. So as you can see, like we have different tabs here. So wherever possible, we put the screenshot of bank statements, loan statements, credit card statements, whatever documents is available are available to us. At times, like inventory confirmation, sometimes client tells us in email that, hey, this is my inventory, so we also kind of take the screenshot and put it as a proof. Sometimes they confirm the cash balance in the email that, hey, this is a, so anything that is helping us to make sure that the balance is matching with the books, we will put this kind of screenshot. So my staff would prepare this, and then he would send it to me, right? The best part about this is that not only it makes my life easy because now I have everything ready, most importantly, how it is helping me, because this is also forcing my staff, because now they need to make sure that each and every account of balance sheet should show the accurate picture, right? They cannot just bluff any numbers, and they cannot just assume any numbers that, hey, this is correct. This will make sure that they need to put some sort of supporting documents. If it is prepaid, I would want them to put the prepaid expenses schedule. If they put the accruals, I would want them to mention what different accruals that they have made, right? So these are different, all different kinds of uh, uh, working papers that we used to prepare, right? And not only it was making our life easy, like because we actually use these working papers and also send it to the CPAs or whoever is filing the taxes. So this also used to avoid so much of communication, right? Because all those questions that otherwise would come up are already answered in form of our working papers, in form of our review notes, right? So it kind of completely avoids any sort of questions from our CPAs. It, because everything is available, the proofs of supporting documents, working papers, proofs, emails, everything is attached with these working papers, right? So this is also a very good practice to follow. I mean, we typically do this every month. I mean, obviously, depending on the size of client, but if every month is not visible, we must do this kind of practice every year, because then it's like a good base, right? So that's that. Now, with Xenett, we have also tried to incorporate the kind of similar functionalities where this is now what we follow. I mean, we still prepare the individual working papers as such, but then in Xenett, this is a practice that we follow for every single balance sheet account. If there is something like attachment, then we would just put it here, and I can easily pull up the attachment right from here, right? So we will still have it not in form of Excel, but we would just attach it to every single account. The reason why this becomes handy is because with the Excel, if amounts changes, let's say for whatever reasons, I mean, we have to keep updating these Excel files, and there's a whole lot of time that we had to spend updating the formulas, and something gets changed. Like if we try to fix one sheet, it just disturbs the another, right? So overall it was helping us, but somewhere deep down, like I kind of felt that it was really inefficient process. So now we just do it as a part of Zenit, where for every single, at least in this particular case, I do not have to export in Excel and things like that, because these are the real time balances that we get from QuickBooks directly. So all my staff would do is that they would come here, they would attach all those working papers, here documents, bank statements, credit card, loan, whatever, like whatever the account is, they would put it here. And I would also want them to, if there are any such accounts where they are not sure, they would just, and this is a custom status that we have introduced, where they would just say, hey, I need to discuss this with you, or this is completely verified. So imagine if me being a manager or reviewer, if I come here, if I see that, hey, all these accounts are totally verified, all these accounts have some sort of working papers, I only have to worry about the ones that says discussions. That makes my life very, very easy, because I have everything that I wanted. Right. Same way, they would also put the review notes. Review notes is more of an explanation. So if they notice something, and if they want, uh, uh, let's say, my attention, they would put it as a review note. So again, like if there any specific thing, I can easily pull up from here. If they had any questions for me, they would use these comments, and then they would ask me that, hey, whatever it is, and then I would just respond it. Same way, if I notice something like, hey, why is this negative, I would go ahead and ask questions from here as well. So for us, at least now, the whole communication or the whole close process has been very, very streamlined, because now it's just kind of getting done at the same place. So I now do not have to look at finances in QuickBooks, working papers in Excel, then the questions in somewhere in my chats. It's all coming up together, right? So this has really been helping us overall with the year-end close process. So yeah, I think this were the main points, guys, that we wanted to cover as a part of year-end close webinar. Uh, I kind of, I'm not sure. I'm kind of looking at different chats and just want to make sure if there are any questions. Okay, my colleague has been responding. So for now, I mean, I'm just gonna enable you, like, gonna make the mics available. So if at all you guys have any, like, if you wanted to share anything, if any different practice that you guys follow, I mean, just feel free to suggest that or ask. Let me just see. I'm gonna just say people, participants. All right, guys. So if anyone wanted to unmute themselves and ask anything or share anything, happy to kind of do that. This was all from my end. I hope you guys really found it helpful. If I mean, we will be sharing these presentations and even checklist as well with you guys. So you guys can then decide, customize it, and implement it for your firm. Just looking at a real quick chat. Oh, so Jim, actually, to answer your questions, you are right. So this is a kind of altogether a new feature that we are already working on. Is just like a we have a different interface for client where they can look at the questions, they can answer it. We are actually creating a same experience, not same, but like a separate interface for CPA users where you can publish financials with working papers, your notes and everything. So even your CPAs do not have to download the Excel file and then ask you questions in the email, right? That might take couple of more months for us to come up with that. But yes, we are already working on that where right from Xenett, you can kind of publish those financials to your CPA with work papers, with your notes, and they can respond it. So again, same way, the entire communications will stay inside Xenett. Yes, Liz, obviously we will be sharing the recording with everyone, so that shouldn't be a problem. uh, all of you guys who are attending this and all of those as well who have not been able to make it today. So yes, we will be sharing this. All right. Any other questions, guys? All right. I do not think as such there are any questions, guys. But yes, guys, we would actually be also sending you guys kind of a survey form where we actually like to also know the feedback, like what are the areas that you would like us to cover, if there are any Zenit users, if there's anything that you would like us to incorporate in terms of close process, anything that where we can actually do better, right? So would just appreciate if you can take some time and help us provide your valuable feedback, because we want to keep improving and we want to make it also always try to make it interactive. So just wait. I mean, we will be sharing that survey and would just love to hear your honest feedback on that. All right. So looks like there are no unanswered questions. I guess we are all set. Thank you very much for attending this. I hope you guys found it helpful. If at all you guys come across any questions afterwards, I will also just say like hardik@zenit.com, or you probably know how to reach out to us, which will be able to help you with any questions. With that said, thank you guys. Take care and we'll meet soon. Bye bye.